Morning, everybody. It's 11 o'clock. We'll get going. Just a reminder too, because I think most people will be watching on YouTube now. But so if you are, by all means, put questions into the chat there, and then one of the team here will be copying them into the Q&A for me, so I can see what's going on. Please don't forget to do that. So welcome. We've got a busy week. I've got some news to run through. We've got Andrew talking about what happened over March, and then Richard's going to be talking to our guest this week, who's Simon Farnsworth of Life Sciences REIT. So bits of news. This is going back because obviously we didn't have a show last week, so it was Good Friday. So just looking at what's happened since the 25th of March. Just a few little things to pick out. JPMorgan American first. Results. So nothing particularly exciting in the results, but except that the numbers are just great. And you can see this chart here. This is a 10-year chart, and it's almost going up in a straight line. It's just crazy, really. And it's got so good now that it's trading at premium and issuing stock. And that's obviously very good news. We need as many good news stories as we can in the sector at the moment. And it's already a £1.8 billion trust. I think it could get an awful lot bigger. The results were great. And to beat the S&P 500 last year was a really quite impressive move. Very few people managed to do it, whether they were US money managers or based here, didn't seem to make a difference. Obviously, that skewed the returns of the world index. Everywhere you go, active managers were tending to underperform. So to beat the index and to beat it by that kind of margin is really quite good. And more importantly, since they changed the approach to running the money, it's built up now quite a good track record of beating its benchmark, which I think is now also a big tick in the box. Here are the numbers from their fact sheet to the end of February 2024, and you can see that just over every time period now it's ahead of the index there, which is obviously good. And the approach, I like it. It's actually, it didn't occur to me this morning, but it's some similar in some ways to what Alliance Trust is doing. So rather than betting on value or betting on growth, it's got a mixture of the two. And it tries to run it so that within sort of like 40 to 60%, you've got roughly half and half of the fund in value or growth. And you can see how that's gone over time. That graph looks a lot more dynamic than it should be because obviously the indices are cut off here. This is just showing the 40 to 60 range. So although that looks like a big move, it's not massive. But obviously a little bit more in growth at the moment than in value. And that's what it looks like in the portfolio. So you've got a lot of kind of IT type stuff, but actually an underweight relative to the index, and overweight financials, and many of which are value stocks, which is interesting given what happened last year. Remember, we had a lot of banking crisis in the US, but I think that probably made a lot of US banks cheap, a lot of financial stocks cheap. And that's definitely what the managers of Pelican Financials would tell you too. There's a holding in Tesla in there, but that has gone by the end of January. So I don't think they got caught by the latest bad figures, which is obviously good news. And then it's a good sort of spread of stuff, but a reasonably concentrated portfolio. So 40 stocks in the large cap portfolio. Obviously, big chunk of whether you outperformed last year was whether you held these Magnificent Seven stocks. And you can see the numbers there, and these have been magnificent for a while. I mean, this is not a new phenomena, but last year was particularly acute, and they generated a big chunk of the returns that the S&P 500 generated overall. And these seven stocks are now so big that they are well over a quarter of the S&P 500 index. They're more than 4 times the size of the small cap index, and they're way bigger than the UK market. Although it's just the numbers are just kind of silly now. The effect of all of that is it skews the style indices. So obviously, generally, large cap beats small cap, but that wasn't true in value. Here, the small cap outperformed. I think that's interesting. And generally, growth beat value. But again, this is really all down to what's going on with these big seven stocks. They really skewed everything. But because of those things, I mean, we had North American income results up this morning, and relative to this, they just don't look anywhere near as good, and that's because they're concentrating this large cap value bit, which is the worst performing in this kind of segment. There is a small cap portfolio too, so it's not it has got some exposure to that area. It's only 5% of the portfolios in sub 10 billion market cap stocks. Remember, US division small cap's a lot bigger than us. But that's very, very broadly spread. So about 40 odd holdings in large cap and about 240 in small cap. And in terms of where the returns came from, that small cap was a detractor. So it took 1% off the returns in dollar terms. But they did outperform the large cap portfolio, and that made all the difference. Gearing helped a bit, which is obviously good. And they do sort of run some gearing, and that's obviously a tick in the box, and that helps offset the effect of fees and gearing costs and all that sort of stuff quite materially. So yeah, basically what I'm saying is this is a really quite impressive turnout. This is the top 5 contributors and top 5 detractors, and you can see. This is the power of NVIDIA there. Just having a very small overweight to NVIDIA added 1.4% to returns relative to the S&P 500. Or good, but obviously the AI story runs beyond those big 7 rather, into things like advanced micro devices and stuff as well. But it's also good, and this comes back to this balance of value and growth thing, that you've got a building materials company there amongst the top contributors. So yeah, tick, tick, tick. Basically, what I'm thinking more and more is that JAM is proving itself to be a core holding in the American sector. So there we go. That's JAM. And now down in strategic, we've talked about this before. It's not very big anyway, so we won't dwell on it too long. But they decided to give up last November. They published a circular in February, and shareholders, so 28th of February, shareholders voted and approved the plan to wind down the fund. They've obviously been freeing up cash, so they announced they were going to hand some of that back on the 8th of March, and they were going to use what they call a B share scheme. So basically, they issue B shares to holders of ordinary shares and then redeem those, and that creates a capital gain or loss depending on your circumstances. And that's a much more tax efficient way of treating things normally. However, this group called Milkwood Capital came along they started buying stock on the 15th of February, so between the second being published and the EGM actually happening. Not clear why the fact that they bought a stake wasn't announced to the market until the 18th of March, because they say they notified it on the 22nd of February. The couple of big investors have sold out. So EQ investors sold out early on, and then later on, Thames Ventures 2 VCTs sold out. And that's allowed Milkwood to build a 28% stake in Down Strategic. That's important because it's sort of blocking the ability to block all sorts of things. So to get the B share scheme approved, they needed 75% of shareholders to approve it, shareholders voting. Obviously, we've got this perennial problem that not everybody votes, and that always creates a problem anyway. They weren't even able to vote all the shares they owned, because I guess didn't get it organised in time. But nevertheless, that was enough, just them voting against, to block the approval of that B share scheme. And the board said they're doing it because they want to run the fund, which we'll come back to in a minute. So that meant obviously the B share scheme thing failed. And the board said, well, looking at this, we still think people want their money back, so we're going to pay the cash out as a special dividend. But obviously that now comes through as income rather than a capital gain or loss. And so therefore, from a tax point of view, if you don't hold it in a SIPP ISA, this might be really bad news, which is not great, to say the least. Going forward, because you need 75% to approve a liquidation of the fund. Milkwood can block that. They block most things they want to do, really, but they can't block them paying more dividends unless it tries to properly seize control of the company. And to do that, they're going to have to go over the head of the board and appeal to shareholders and say that we don't want to do this wind down anymore. Give control of the fund to us. So if I was them and I've got a decent case to make, I would now call an EGM and get shareholders to vote on that proposal. And if shareholders don't want to cancel the wind down, then by all means they can take the shell at the end. So we'll pay out all the assets that are in the company. They can take the shell at the end and use that shell to do something if they want to try and raise more money for what they want to do. And what they want to do isn't clear, but the guy who runs Milkwood used to be head of emerging markets at Citi, and he's contrarian, he's activist, quite focused. So another kind of fund, maybe a bit like Aurora, maybe, or Castlelaw. We'll just have to see what happens here, whether he just gives up and goes away. Watch this space. Finally, for me, a quick thing on Fidelity Emerging. We know that that's had a terrible period, largely related to it got handed over to Fidelity. They piled into Russia. They lost a fortune. It's starting to recover, but the discount's still quite wide. It's a decent size. This is ranking them by market cap. It's still the third biggest fund in the global emerging market sector. So it's a decent pool of assets that somebody would love to have their hands on, especially when you've got a new entrant like Ashoka who really wants to get a lot bigger. So it would be an obvious bid target for them, or just an attempt to get the whole management contract for it. The returns were dreadful, and you can see this in the 3-year numbers here, and that's related a lot to what they did with Russia. But they have perked up a bit over the last year, which is helpful. And they are actually now beating the benchmark, which is also helpful. So I think they're starting to build a case again for hanging on to it. But there's a long way to go, I think, with that and shareholders. So they've just had a tender offer. There's 90 million shares in issue. Almost all of those were tendered. So basically, everybody just said, yours. We'd rather have a cash, please. But the tender was limited to 13.5 million shares. Actually, the thing I picked up on is that 79.8 million shares is more shares want to get out now than couldn't get out last time. So they had a big tender before, if you remember, and everybody took that as a big vote against the Fidelity running the fund. And so the situation appears to have deteriorated. I don't think it's enough for the board to sit back now and go, well, we've done the tender, we tick that box. I do think that Fidelity have to really build a case and go to shareholders and say, do you want us to carry on running this? Or the board needs to do that. Do you want Fidelity to go and carry on running this? Or shall we find a new fund manager, or shall we do something more radical with here and maybe just to liquidate it? I obviously don't want it to be liquidated. It's their biggest fund in the sector. I'd much rather the assets went to a manager that people actually want to be invested in. But I do think that there's a serious question being asked here that needs to be addressed. So that's enough from me. Let's now talk to Andrew.
Lovely. Thank you very much, James. Let me just share my screen and we'll talk about what has been happening in markets in March. Good. Well, actually, March was a very interesting month because we had an enormous amount of news flow in the sector that really caused some quite substantial price movements. Here's the list of risers. And actually, if we were to work down the list, we could probably explain nearly all of them in terms of news flow. So just a few gold and prospect precious metals was benefiting there from a rising gold price. Digital 9 infrastructure, we know managed to push through the sale of Verne Global, Taylor Maritime Investment benefiting from disruption of global shipping, 3i Group benefiting from the strong trading news from Action, Custodian Property Income REITs actually bounced back because its bid failed for Aberdeen Property Income, etc. So effectively, I think it was a news-driven month rather than the market having a considerable strength of direction. And that was reflected really in the market index, which was up about 2% for investment trusts over the month. I think it lost about half of that this morning. But anyway, so there wasn't an overall strong directional trend, but nevertheless plenty to keep us interested. The thematic that I picked out from this was actually natural resources. You can see 4 commodity trusts on the list there going up, so I'll talk about that in a moment. On the way down, there's an outstanding figure at the top, of course, which is Asian Energy Impact Trust down 77%. That's because it came back to the market after its long suspension. So no surprise there, it came back at a much lower price. And I think here the outstanding feature, without any doubt, is the renewable energy space, which really suffered again in March, which is perhaps somewhat contrary to expectation because we felt it was quite sensitive to interest rates. And generally speaking, the news on the macro has been looking a bit better. I think there's quite a lot of consensus now centering around a rate cut, perhaps in June in the UK. But anyway, I'll talk about that as well. So let's have a look at natural resources, which really have had quite a good, strong start to 2024. The chart here is for the S&P Goldman Sachs Commodity Index, which is up 12% in the year to date. That's a broad index that covers all sorts of commodities. And actually, it doesn't take very much research to have a look at the news flow here and see just how positive it is across a broad range. So we know the gold price is at an all-time high. That's, I think, for a range of factors. Partly it's a reduction in interest rates because, of course, gold doesn't pay any dividends. So actually, the opportunity cost of holding it goes down when interest rates fall. There's also, I think, quite a lot of geopolitical hedging going on there where people are buying gold because they're worried about developments in the Middle East and still in the Ukraine and Russia. And of course, as well, you've got the influence of Bitcoin, which has been rising strongly. And I think that does also encourage people into gold as well, rather curiously. But it's not alone. So copper is also at a 14-month high. There've been quite a lot of supply disruptions here in places as diverse as Panama and Congo and Zambia. It does mean actually that if we do see a pickup in demand, I think the copper market may find it quite difficult to respond to that, which is why there's a bit of a squeeze on prices now. And actually quite a few banks are indicating in their forecasts that they're expecting that rally to continue. And oil is at a 5-month high as well, again, partly due to tensions in the Middle East. So there's quite a lot of impetus here, I think, and a double whammy, I think, from potentially falling interest rates. Because on the one hand, as I've explained, that's good for precious metals that are not yielding anything. And of course, it should also boost global economies and global trade, which is helping the more cyclical metals like copper improve. So I think both from the supply side and the demand side, you've got factors here pushing up prices. And I think actually there's quite a decent range of trusts in the sector. Many of them are quite small, but I've ranked them here by 1-month NAV return. And you can see there's a number that don't appear to have moved, but that's because they're largely in unquoted assets. The ones that are in listed equities have actually all done very well over the month, topped by Golden Prospect Precious Metals, which is about 80% gold. So that's really why that's at the top. Next on the list is BlackRock World Mining, which is really, I would say, the only large liquid trust in this sector. It's got 1.1 billion pounds of assets. and it really dwarfs the others. So if you're needing some liquidity, that's really the one you're going to look at. The other reason to look at that trust now is that it does have the most negative Z score, meaning that its discount has varied the most at the moment. It's on a discount of 9.3% compared to its 1-year average of 3%. So in spite of the improved performance, the discount has widened. And this is a curiosity, actually, that I saw some interesting data from Panmure Gordon, and they were pointing out, actually, that this has been happening across the sector, that where NAVs have been rising, share prices have generally been lagging, and vice versa, which explains partly why discounts have widened in the Indian sector and have narrowed in the Chinese sector, just because share prices have not been reflecting the full movement. Anyway, to come back here, you can see from this chart at the bottom how the discount has just broadened over time here and is now approaching 10%. And this is quite a well-diversified trust. If you have good eyesight, you can see on the left here that it has 36% in diversified miners. So that's companies like Rio Tinto. And this is looking through. So it's not holding these commodities directly. It's doing it through equities. But 23% in copper, 13% in gold. So quite broad exposure. What you're not getting with this trust is any energy exposure. So it's not investing in oil and gas here. If you want that, you'll need the sister trust, the BlackRock energy one. But I do think it's quite interesting at this point because you're getting a bit more value here, and there does seem to be quite a lot of momentum in this sector. There's just one curiosity I'll just talk about very briefly. In the same sector, Geiger Counter, the uranium mining equities investment trust. This is, I think, probably the only trust now to be using subscription shares. Very close to my heart, these things. But it's a good way of expanding, actually, when, of course, trusts are finding it tremendously difficult to raise any new capital at all. Geiger Counter has an annual mechanism for this where effectively shareholders are given the rights to buy new shares on a 1-for-5 basis at last year's NAV. And this time around, this opportunity is coming up at the end of this month. And the subscription price at last year's NAV is way below the current share price. So the subscription price is 37.74. Current share price is about 56. I just wanted to mention this because I want to urge anyone who is a holder to take up those rights because they're actually quite valuable. And if you don't take them up, you're missing out and getting diluted. So I think it's good news. I think it's an interesting mechanism and it does enable the trust to expand a little bit at a time when it's quite difficult for most to do so. So on the way down, renewable energy has had such a tough time, actually. And it's not because NAVs have been disastrous. Over the last year, I put the figure on here, NAV total return from the sector is plus 2%, and the average share price is down 17.4. So there's been this very big derating that's continued over the last month. Again, NAVs were up slightly over the month, share prices down nearly 5%. There are some reasons for this. I mean, it's not happening in a vacuum here. And I think investors are concerned about revenue weakness in the sector. And of course, it really hasn't helped that was very marked in the battery storage sector, which I think has cast a little bit of a cloud over sentiment here. And more broadly, there are concerns over power prices falling. I think that's a really interesting topic because if you do speak to managers in the sector about that, they tend to dismiss these forecasts as being a necessary evil, but not necessarily very accurate because it's difficult to look out several years. So that debate will continue. But in the meantime, we've seen this very sharp derating. And I've just pinched this chart here from Stifel Stockbrokers, who have looked at all of the sectors across the investment trust market over the first quarter of the year. And you can see, actually, they've nearly all derated. So this has been a broad derating of the market. But renewable energy infrastructure on the left here clearly stands out as being by far the biggest derating. After that, it's hedge funds, infrastructure, and quite a lot of property sectors. But I do think this big derating could potentially give you an opportunity to jump in. Many of the yields in the sector do look quite compelling now. Between 7-8% on at the low side, up to maybe 11%. And clearly, you have to do your homework and make sure those are sustainable dividends. But I think now most of them are. And there seems very little doubt, actually, that in the majority of cases in the sector, the NAVs are quite firm now. They're quite realistically based. So I think there's some value there, and it could be that there's been some overshooting going on here. I think if you're an income investor, it's especially interesting. You can lock in these quite high yields now. Just one more slide. This is something, again, that I think was brought to mind very much by the news flow this month, and the news that Elliott had taken the 5% stake in Scottish Mortgage. I was just thinking about it, and the fact that Elliott's actually done very well out of this already and had quite a significant uplift in their stake. And also that Saba Capital, who was the earlier arbitrageur to come in, has actually done very well from its holdings, I think. So I wonder whether this might tempt some more ARBs into the sector, or potentially Elliott might take some more stakes elsewhere, which it has done in the past too. Elliott's not new to the sector. It was around at the last time that arbitrageurs came in the cycle. And there's actually quite a lot of double-digit discounts. I mean, as that chart from Stifel showed, the discounts have broadened right across the range here. And there are some quite large liquid equity trusts here that I think are trading on wider than normal discounts that could tempt ARBs. I did a bit of a sweep of this and wrote about it in this month's newsletter. I picked out 5 actually, but I've just got room for a couple here. So I'll give you 2 of the names we picked out. Temple Bar, which is on a 10% discount. I know you've just put out a research note about that, James, so you can go and have a read of that. I think it's quite attractive now on a 10 discount compared to its 1-year average of 6.2. Again, liquid trust actually doing okay at the moment. A trust that is really struggling, though, is Baillie Gifford Shin Nippon, which has had an awful time of it, actually. But again, I think it's interesting to put this into context and to remember that this was actually a really good trust for a very long time when growth was actually in favor. And so the 18% discount on this now is not only wide in relation to its 1-year average of 12.6, but massively wider than it had been previously. And I do think actually there's quite good scope for recovery here, or some action. And you can see, from the charts in the bottom right here, that discount's just got wider and wider. And again, I just wonder whether that could be tempting for someone. That's just me speculating, so we'll see. That's it from me now. I don't think I have any questions, so I'll hand you over
Cool.
to Richard.
Thank you, Andrew. I mean, just an observation on Temple Bar while we're here, because we noted this week, it massively outperformed Merchants Trust last year. But Merchants Trust issued 40 million quid's worth of stock, and Temple Bar shrank. There's no logic going on here. I need people to look at things more carefully before they pile in. There we go.
I think that's right. There's quite a lot of anomalies in the sector, and that's your job to help point them out, James.
Exactly. Cool. Right then.